Greetings, everybody. Today, we'll talk about the world of capital markets. The capital markets consist of the NSE and the BSE, which is NSE is the National Stock Exchange and BSE is the Bombay Stock Exchange. So, whenever you buy the stocks, you buy through these exchanges, and all your stocks are moved to your central depository where all your stock are being stored and deposited. So everybody thinks it is a risk to invest in the stock exchange, which I personally think it is not if you know how to manage risk. So here we'll discuss about three important aspects, which is the large cap, mid cap and small cap. Large cap are those where the risk is very less and as a starter you begin with it. And definitely the stock exchange or the share markets is not for a short term. I recommend to go for a long term, at least 5 to 10 years. Because there is a power of compounding in every aspect. If you're able to get the power of compounding, is nothing better than that. In share markets, there are two types of trading. One is the intraday trading, which is the day in and day out, and the other is the cash and carry, which we call the CNC, where you stock or store your shares for a long time and sell it when your shares are in good. Because you always need to know the fundamentals of the stock what you're buying. It's better to know the company what you're buying. NSDL, as already I spoke, it is the place where all your stock are stored. There is an approach called top to down approach and down to top approach. So top to down approach talks about the economy sectors in the company, whereas the other one is the reverse. So you should always check the company's growth over a period of time. If the company is giving a good growth over a period of time, then it's a better stock you need to select. And the next thing we need to check is the PE, which is the price per earning share, or the ratio, where you need to check if it is in line with what we are buying. Here I can show you some of the IT companies like HCL, Wipro and Infosys, and you can see how the stocks has improved over a period of time. The next is about the Nifty, which is an index fund, and there are a lot of index funds like Nifty 50, Bank and Auto, and you can see how it has risen. The next thing is about the ETF, which is the exchange traded fund. It's better to invest in exchange traded fund. As you see, it is always equal to Nifty 50.